The ongoing saga of will they, won't they reach a compromise in Washington for a fifth-round stimulus package appears to have had a disappointing conclusion, with negotiations falling into yet another stalemate. According to the Treasury Secretary, after weeks of negotiations and several rounds of legislation from both the Senate and the House, there is little hope of reaching a comprehensive deal before November 3rd. With the presidential election less than a month away, both sides remain under ample political pressure to provide additional support to individuals and businesses hard hit from the pandemic, those struggling from a loss of revenue, income, and opportunity. Even the chairman of the Federal Reserve has been increasingly vocal in support of further fiscal stimulus, warning of dire economic consequences should the government fail to act. And indeed, officials from both sides of the aisle have conceded a need for additional funding, but there remain notable differences over the size and scope of further support, particularly when it comes to additional PPP funds, a bailout for the airlines, and monies for state and local governments. Of course, to be fair, the government has already taken sizable steps to help aid domestic growth, providing trillions of dollars in support, trillions of dollars for testing, small business loan subsidies, checks to households, loans and grants for small businesses, bailouts for the airlines, tax credits for employers, and of course, increased unemployment benefits, funds which have provided a welcome cushion for many Americans. In fact, with some lucky enough to remain employed and others with access to generous unemployment benefits or other government funds, real disposable per capita income, for example, has actually rose substantially early on during the pandemic, pushing to $52,000 in April following the passage of the first round aid package in late March. Now, since then, income growth has slowed somewhat. However, compared to pre-pandemic levels, compared to February levels, the average American is still better off, with an average of $47,000 as of August, a difference of nearly $1,000 or roughly 2%. Coupled with a reduced pace of expenditures resulting from both uncertainty and restricted access to goods and services, rising incomes have also led to a substantial increase in savings during the pandemic. Americans have saved nearly $2.5 trillion, translating into a savings of roughly 14% as of August. While a notable reduction from a near 35% peak in April, the current pace of stored wealth is nearly double the pre-pandemic rate. Bottom line, with meaningful gains in income and savings, the average American may be somewhat better off post-pandemic, or at least in a stronger financial position than was previously assessed. Such a conclusion potentially alleviates, if not eliminates, pressure on officials in Washington to unveil an additional tidal wave of fiscal support, at least in the near term. Going forward, a prolonged impact from the virus will exacerbate the need for future artificial support for the market. However, at the moment, with a sizable savings or wealth cushion accumulated after months of enhanced benefits and access to federal funding, the looming fiscal cliff without the passage of a fifth-round aid bill may not be as ominous as feared.